Okay, I'm gonna wait a couple minutes, I think. So what do you think? I should send an email out with this link?
Yeah.
Let's see, what, can you, in the chat room, can you tell me what link it is so I'll send an email to everybody?
Okay, let me copy the link.
See if you can find it, copy it and put it in the chat. The Zoom is,
Is this your personal Zoom?
Professor.
Is it there? Let's see.
I think that the other people are using the other link.
Is this it, Nicole? Okay. All right, thanks. All right, I'm gonna send this out to everybody then. I'm gonna send an email to everybody. Thanks a lot, Nicole. All right, so here what I'm gonna do is I'm gonna share screen. I'm gonna go over here. Let's see, maybe with my regular PowerPoints.
Professor, it'll be better if you put it in the actual message.
Hold on one second. I think that's going out to everybody. Okay, let's see here. All right, we got 7 people. Who was talking? I couldn't hear you.
I was saying that it would be better to put it in the main message. That way everyone can click on it. In the header, you can't click on it. If you put it the message the link on the bottom.
Oh, okay. Put it in the actual message, right?
Yes.
Okay. John, I want to go. Chat only goes to them, John. Please, just calm down a minute, all right?
Oh, okay. Let's put on flat.
All right, I think I sent it out. I think it's okay now. Well, let's see here. Oh, this is not making me nuts.
Yeah, you sent out the new link.
Okay, good. Thanks a lot, Yehuda. I appreciate it. Okay, so we're up to 26 people.
Well,
I'm going to pause the recording for a second. Now, here we go. Okay, so we're going to start. We got about almost 50 people, so that's good. All right, so let's start. Today we're going to do 16, 17, and 18, and we're well on our way to finishing the book. So here's 16. So this is using effective promotions. Can everybody see it?
Yes.
You can see, can you see 16?
Yeah.
Okay. So here's promotion mix. And just like, I'm just going to hold my hand up. Let me see if I can see myself over here. So, okay. So just, these are like the tools that every company has to get their message out. Okay. So it's called a promotion mix. So some companies do a lot of advertising. Some companies do very little. All right. Sales promotion, thing like that, personal selling. You have publicity, public relations, even direct marketing. Some people, all right, so here's your traditional promotional mix, the key terms. So it's a combination of the tools that an organization use. Now, some companies use all of them. Some companies use just a couple of them. Some companies use none of them. As a matter of fact, very interesting. As I said, Costco does just about little or no advertising, all right? They have booklets they send out to members, but you don't really see a Costco ad if you're watching television. Think of a company like McDonald's, all tremendous amount of advertising, thing like that. Many companies do lots of advertising. So it's up to the company. So there's no real right formula, okay? But you want to spend your money wisely, all right? So here it all falls under something called IMC, Integrated Marketing Communication. So the key operative word over here, technique that combines the promotional tools. So it's called synergy. You know what synergy is? Synergy is actually where 1 + 1 becomes 3. Now, I know mathematically 1 + 1 is 2, but synergy means when you have the combined effect of a very, very effective television commercial program, an online internet program, personal selling, when you add it together, instead of 6 + 6 + 6, 18, 6 + 6 + 6 becomes 20. You have the synergistic message, all right? So it combines all the tools together, okay? So the steps in a promotional campaign, there's about 6 of them. First, you want to identify your target. Well, who are you advertising to? So if I'm Callaway Golf Clubs, guess what? My ad is directed at people that play golf. And that could be a tennis player. Maybe you have a person that plays tennis who also plays golf. Maybe you have a tennis player that says, you know, I never really played tennis. I think I'm going to take it up. This summer, I'm going to take golf lessons, and I'm going to go buy some golf. So vice versa. You might have Wilson, who makes tennis rackets, try to lure a golfer into playing golf, all right? Playing tennis. You define the objectives for each element of the promotion mix. What objectives do you have? Sometimes you want to identify a new product, all right? You want to talk about reminder advertising. You know who does reminder advertising? Coke, Pepsi, Heinz tomato ketchup, companies like Hellman's mayonnaise. Reminder advertising means you're just telling the people the brand is there, and then switching. Switching would be Verizon will run an ad and say why we're better than AT&T. You should switch. Toyota will say you should drive a Toyota Camry instead of a Honda Accord. We want you to switch, all right? Those are usually how much you're going to spend, the budget, how much you want to spend on advertising. By the way, it's a very, very worldwide. You have billions of dollars spent on advertising like that. Oh, by the way, the largest advertiser, consumer products advertiser, is Procter & Gamble. Procter & Gamble, they spend worldwide about $8 billion on advertising for Procter & Gamble. And just in the United States alone, they spend about $4 billion, all right? You develop a unifying message. One of the unifying messages that I like the best of all is Walmart, 4 words: save money, live better. So when you hear that message, thing like that, it really speaks volumes, even though it's only 4 words. They're saying if you shop in our stores every day, day in, day out, to get your consumables, you'll live better and you'll save money. Why? Because you'll get $200 worth of merchandise, but you're not going to pay $200 for it. Where Walmart, you're only going to pay $165. You're going to save $35 a week, 52 weeks. That's a couple $1,000. And with that $2,000, you can live better, drive a better car, go to the movies, go out to dinner, take a vacation. So save money, live better, right? Implement the plan. This is where the rubber meets the road. You roll out the plan and you use the different media types, and then you evaluate your effectiveness. And let's say like you have a plan where you're using radio, television, and newspapers, and most of your orders, or when people contact you to use your product or service, they say, I heard your ad on the radio. You say, wow. Then another person, I heard your ad on the radio. You say, well, wait a minute. We're very effective with radio, but very few people mention television. Nobody mentioned newspapers. Let's drop newspapers. That's the way to do it, right? So here's what is advertising textbook definition is. It's paid. You have to pay for it. It's non-personal communication. It's between the advertiser and you. You're watching television, all of a sudden you see a Toyota ad. It's not like a personal. I'll tell you what personal communication is. You get a letter in the mail. You get a phone call. You get an email, something like that. That's personalized, and that's direct marketing, all right? So advertising non-personal by various media of individuals and identify a product in some way. They tell you why the Toyota Camry is a great car, right? Now the impact of advertising, total U.S. expenditures, $241 billion. I told you of that, Procter & Gamble alone, one company does $4 billion alone. And worldwide spending is $500 billion, all right? 560 billion is $500 billion, a thing like that. Consumers benefit because of production costs. Now, what do they mean by that? So if I want to watch the Super Bowl, which I did this past year, I thought it was a very, very interesting game. I just sat down. I have a nice big screen TV, high definition TV. I sat in my living room. We had a little party thing. I had 4 or 5 people over. We watched the entire game. Didn't cost 1 penny. As a matter of fact, I probably had a much better view of the game than anybody in the stadium. All right. I think, wasn't it J-Lo and Shakira? Didn't they perform this past year? So you saw a very, very entertaining halftime show. It's almost like going to a Broadway show or something like that. You saw close-ups. You can see the play calling. You see the huddle. You can read the quarterback's lips in the huddle tremendously. Thing like that. You see the replays. Thing like that. Didn't cost me a penny. So they pick up the production costs, but the advertisers have to pay for it. They say it would cost $5 million for a 30-second commercial during this past Super Bowl. $5 million. That's about $150,000 a second, right? And marketers choose the media with the best impact for them, right? So television advertising is still the dominant media. All the different networks, CBS, NBC, Fox, ABC, then you have all the cable channels. They get a lot of advertising. And I'll tell you what product placement is. It's putting products on TV shows or movies. So I'll give you an example. You see, there's like a love story between, let's say, Jennifer Aniston and Tom Cruise, all right? Something like that. And it's like they had a falling out. It's like a love story. So Tom calls up Jennifer Aniston and said, honey, let's see if we can patch this up. Let's meet in our favorite place. The next scene, you see a Starbucks. They do a close-up on Starbucks. You see Tom Cruise sitting there looking at his watch, and it's an Apple Watch, right? All of a sudden, Jennifer Aniston walks in, and she's carrying a Michael Kors handbag on her shoulder. She puts the handbag down on the table, a thing like that. So then they order something like that. She checks her watch, and it's a Boulevard or something like that. The scene ends. They talk for a while. The scene ends. She leaves, and she says, I'm going to have a cigarette. She takes out a Marlboro. She takes a Marlboro out. He lights a cigarette for her. He said, honey, how are you getting home? She said, I called Uber. You see a Ford Focus pull up. He opens the door for her. She gets in the Ford Focus, and you see the car pull away. There was about 10 things in that one scene in the movies. 10 items were put in there as product placement. And they're part of the story. You don't even realize that you're seeing it, right? So here is what is an infomercial. It's a full-length TV program devoted for exclusive. When they say full-length, usually they're 2 minutes, 3 minutes. Sometimes they're half an hour long. You can see it if you watch some of the channels on Sunday afternoon. You go around and like channel 5, channel. Is somebody talking?
Certified personal trainer.
See, I think I have to mute everybody over there. Let's see if I can.
Whatever the fuck BS
The guy's got to stop talking, if you would, please. Hold on a minute, okay? An online ad is an attempt to get potential customers to visit a specific website to learn about a product or service.
Doesn't mean that everything they're preaching about is reliable. I've been seeing people.
I don't know why. Let me see that thing in the background over here. Let me see. 1 second. Stop here. Let's see here. I want to mute everybody. Let's see. What do I mute everybody?
Certified nutritionist trainer.
No.
Screen.
Participants. And click mute all.
Okay.
Yes.
All right. Okay. Let's see. I have to go back over here. Sorry, everybody. I had somebody that was talking over here, and I couldn't hear myself. Okay, so that's where we are. So it's an infomercial. So the infomercials, they usually sell devices like gadgets, a thing like the choppers. You've seen many of them, okay? An online ads, all right? So an online ad is you're watching an ad on the internet, all right? So personal selling is another part of the promotion mix. This is a professional salesperson working for a company. You see a lot of personal selling, automobile, insurance, a lot of financial product, a lot of the better department stores. You're going to Saks Fifth Avenue, you're going to Nordstrom, Neiman Marcus, you have people working in personal selling, okay? So helpfulness, here's a young man, you see a picture, he's telling everybody the merits of this car, and they're walking around, and they also take you out on the test drive for the car. They talk about financing, are you gonna lease, you're gonna buy, what color do you want, when do you want, thing like that. So that's the story there. Public relation is another element of the promotion mix. It's a management function, evaluates public attitudes and changes in policies. And there's really 3 steps in a public relation program. First, you want to listen to the public. What is important to the public, okay? Change policies and procedures. So we're going through a change. We have this, we're going to implement. The public told us they want this. We're going to implement it. And finally, inform the public that we've changed and made the change, okay? So I'll give you an example. Say like a company, a website announces, they find out that most of their customers like free shipping, okay? And they poll their customers, and so they announce that effective immediately, all of our products are going to be free shipping. Anytime you shop with our website, everything is free shipping. And then you inform the people, right? That's the way that works, all right? Publicity is a little different. It's any information about an individual product or organization distributed through the media. So publicity is like a newspaper story, right? You're reading the New York Times and you announce the Zicklin School of Business is now having a new discipline, you can major on artificial intelligence. We're going to teach students how to do artificial intelligence. We're having a new math MBA program, and it's going to be on something like that, information tech, something like that, something brand new. So that would be an announcement. It's a newspaper article. You see, it's a news story. Maybe you're watching television, Eyewitness News, and they talk about Baruch College is making a major. Well, we just had a new announcement. We have a new president, so that's a publicity, right? Usually, it's news that's favorable to the company, and sometimes if it's damage control, sometimes if something negative happened, they go in and they try to do damage control. They're going to talk about how to try to repair the problem. That's publicity, all right? So sales promotion is the promotional tool that sells. Not only do you have to sell the customer to buy the product, you have to sell the retailer to stock it. Let me give you an example. So like I'm Campbell's and I come out with a new soup, turkey mushroom soup. We've never had turkey mushroom. We developed it. So I want the customers to buy the turkey mushroom soup. So I'm going to give you a coupon. I'm going to give free samples away. Something I have taste testing like that. We're going to have all kinds of price back. We're going to have, but so that's directed to the consumer. But also I got to get the stores to stock the soup. So I'm going to direct sales promotion to the stores. I'm going to have free merchandise. I'm going to have counter signs, many contests, sweepstakes, lots of sales promotion. So it's actual dual constituency on sales promotion, not only to the consumer, but also to the store. So here's consumer promotion. I'll let you look at these. There's quite a few of them. Word of mouth promotion, sometimes it's referred to as WOM. Word of mouth is you try to get people to tell others about your product or service. And usually, hopefully, it's favorable, right? So you have a new restaurant and people come and visit your restaurant. They like the taste of the food. They go and they say, everybody, oh my God, you got to go to this new restaurant that opened up. It's delicious and the prices are affordable. The wait service is excellent. But the other side of that coin is sometimes negative word of mouth can be the opposite, where people visit your place of business and they're not happy with it and they tell everybody the food there sucks. So don't go to that new restaurant. So it's a two-edged sword, all right? So here is a push versus pull strategy. Push strategy is a normal channel of distribution that we discussed last time. Producer aims their promotions at the wholesaler. The wholesale aims it at the retailer. The consumer. All the arrows are going this way. Pull is different. The commercials are directed directly to the consumer. I'll give you an example. By the way, it's used very widely in the pharmaceutical industry. You'll hear an ad, it'll say something like this. You wake up in the morning headachy and drowsy. You have chronic sinusitis. Speak to your doctor or pharmacist about our new miracle steroid, Nasonex. So you hear that commercial a few times over, and the person says, yeah, every morning I wake up, I'm all bleary-eyed, headachy. So you go to your doctor, pharmacist, you get the Nasonex, you go into Rite Aid, you go into Walgreens, you go into CVS, and you buy the Nasonex. Now, those stores have to go back to Pfizer, who makes that product. So you know what I'm trying to say? So the ad is directed to consumer, and then the consumer goes into it. So that instead of it going this way, it's going to push versus pull, right? I believe that's the last slide. Let's see, that is the last slide. So we finished up chapter 16, so now let's go to 17. See what happened over here. Okay. Can everybody see 17?
Yes.
You can see it?
Yeah.
Okay, great. So here is, now we finished marketing. So actually 16 was the last segment of marketing. Now we're starting a whole new discipline. This is the last section of the textbook. It's 17, 18, 19, 20. So the first one is accounting. Accounting is a very, very big discipline in Baruch. As a matter of fact, until recently, I still think it's the case. The most CPAs of any college in America graduated from Baruch, right? So Baruch has a very, very big accounting department, the thing like that, and we're very, very prideful of our accounting people, even, all right? So here's key term. Notice there's quite a few terms to learn in accounting. So what is accounting actually? What's the textbook definition? It's the recording and classifying, summarizing, and interpreting of financial events and transactions to provide management with what's going on, but also outside people, because they want to make decisions. How are we doing, all right? So who's interested in these metrics? Outside employees. If I'm working for a company, I'd like to know how the company's doing. Are we making money? Are we losing money? Something. Owners. Yeah. How is my business doing? Creditors. So if a company, so if I'm Apple, and a company wants to buy, 1 million iPhones from me, thing like that, 1 million units, I want to make sure I'm going to get paid. So if I'm a company like Radio Shack, and it was like a year before they went out of business, I'm not going to ship them that merchandise. Same with Toys R Us. Same way if I'm Mattel, and Toys R Us wants to give me a $10 million order for Barbie dolls and for these little toy cars, I'm not going to ship it to them. I'm going to say, you're too shaky. So that credit to unions. A lot of times unions want to know how the business is doing so they can ask for additional wages, different benefits. Investors, if I'm buying a stock or I'm considering buying a company, is the company making money? What kind of money? What is their source of funds? And the government wants you to pay taxes, all right? So here's the accounting cycle. It's a 6-step. Notice there's 6 steps in the procedure. You're going to see it's coming up. Procedure that results in a preparation analysis of financial statement. That's what accountants do. They produce the financial statements, they make sure they're accurate, and then they publish the financial statements to outside parties. And bookkeeping is a subsector of accounting, the recording of business transactions. Bookkeepers divide the firm's transactions into meaningful categories, and they post them in something called a journal, right? So here's your 6, remember I said the 6-step thing, here's your 6-step process. First of all, they analysis source documents, sales slips, they record the transactions, they transfer, they post a journal entry that goes into something called a ledger. Then they take a trial balance, they make sure everything is in balance. Accounting is always in balance. It's never like this. Everything always has to balance. It's like a seesaw, perfectly balanced, right? Okay, and then they prepare financial statements, which includes your balance sheet, your income statement, and your statement of cash flow. And then the last step is analyze financial statements. So they sit down a lot of times at board meetings, the CFO of the code accounting, the chief financial officer, and the accounting department. They sit in these meetings and they say, how are we doing as a company? Where are we getting our funds from? What divisions are producing the most profit? A thing like that. Which divisions are costing us the most money to run? So in a financial statement, it's a summary. Key operative word there is summary of all the transactions that have occurred over usually 3 months, 6 months, or certainly annually, right? And the balance sheet is a financial statement that reports a firm's financial conditions. Don't forget, it's got to be in balance, all right? Assets, liabilities, owner's equity. We'll tell you the formula for that in a couple of slides. The income statement is a financial statement that shows the firm's profit, costs after expenses and taxes, and it summarizes where did the money come from. And finally, a statement of cash flow. It reports cash receipts and disbursement. How much money is coming into the company, how much money is going out of the company, all right? Usually, every company wants more money coming in than going out. That's the way that works, okay? So here's your fundamental accounting equation. It's assets equals liabilities plus owner's equity. Let me give you an example of that. Say like you have $500 in the bank, all right? You have $500 in the bank, but you owe your Uncle Patrick, you owe me $100, all right? You have 500, but I loaned you $100 January 1st, remember? And I told you August 1st, I want you to pay me that money back. So you have a liability. You have assets, $500, but you owe me $100. So you take 500 minus 100, your really net worth is 400, okay? Now you can reverse that. You can say owner's equity equals your assets minus liabilities. You can take any kind of equation, and if you know your math, you can move the equations around, okay? So what is an asset? It's an economic resource. It's something of value. It can be tangible or intangible. If I'm a company and I own say like I have a limousine service, Staten Island limousine, all right? I'm based on Staten Island, and I have 10 cars on the road, but I have this big garage that I store my cars in the evening. It's a car repair service. I have all kinds of lifts. We did the oil changes, tire rotation. So I have a building. The building is worth $1 million, and each car is worth, when I bought them, $1 million, $100,000 each. So that's $1 million in cars and $1 million in the thing like that. So I have $2 million assets, all right? And sometimes the names, you see where it says intangible? It can be a logo. You know Nike swoosh, you know that checkmark swoosh? That's a tremendously valuable logo. The golden arches, the McDonald's, the golden arches, that logo is very, very valuable. It has a certain amount of value to it, right? Same thing, Levi has that little thing, the little red thing on the pocket, the back pocket says Levi. That's actually a logo. Liquidity, very interesting. The ease at which an asset can be converted to cash. Now, the ultimate asset is cash. And then you have other things, inventory can be a very valuable asset as long as you can sell it. Now, if you're in the retailing field right now, we're already in the middle of summer. Say like you're a big retailer like Macy's or Bloomingdale, and you got swimsuits that just arrived. They have a certain amount of value, but as time goes on, they become less valuable because we get further into the summer season. A person may say, nah, I'm not even going to go to the beach at all this year. With all these beaches slowed down, covered down, I don't want to go to the beach with a big mask on my face. I'm not going to go to the beach. So the value of those swimsuits go down. You might have to mark them down. $100 swimsuits, you wind up selling them for $19.99. And then maybe you have an outdated warehouse. Say like you were a company, and years ago you used to have a big distribution center in Omaha, Nebraska. It's in the middle of a field or something like that. It's a big building thing like that, but it's in need of repair. The roof has leaks in it, something that's in a rundown rural area. And you think that building is worth $5 million, but try to sell it for $5 million. Maybe you're lucky if you could get $500,000 for that building. So the idea over here, so liquidity, how quickly can something be turned into cash? Now here's some other classifying asset types. Current assets are items that will be converted into cash within 1 year. Okay, most of the time it can be your inventory or something like that. Fixed assets are assets that are relatively permanent, such as land, building, equipment. Okay, and then finally, intangible assets or long-term assets are patents. Say like I have a patent on a drug. Now, there's a lot of companies right now, Pfizer, Merck, all these companies are trying to come up with a vaccine for this COVID-19. So as soon as they come up with the exact formula for it, and it's tested and it gets the FDA approval, they're going to patent it or something like that, and they have exclusive rights to that thing. I think it's 19 years or something like that, right? Trademarks. What's a trademark? It's the logo or the brand name of your company. Coca-Cola is a trademark. Copyrights. When you write something out, a song, or if I'm an author and I write a book, J.K. Rowling, when she wrote the whole Harry Potter series, she got copyrights on all of her manuscripts, and when she got them published, they're very successful, and she became a billionaire, right? So here is liabilities. What is liabilities? What the business owes. The key operative word is others, all right? I'll give you an example. So like I'm Macy's, and I have arrangement with Ralph Lauren. Here's Ralph Lauren, here's Macy's. I do very well with Ralph Lauren merchandise in my store. So Ralph Lauren ships me for back to school for fall, coming over here in August, September, $1 million worth of denim jeans. All right, so here's Ralph Lauren, Macy's, they ship me the jeans, $1 million worth of denim. I owe Ralph Lauren $1 million, okay? Now I'm not gonna sell the jeans for $1 million, I'm gonna sell the jeans for more than that. I'm gonna sell the jeans for $2 million, something like that, maybe, okay? But right now I owe Ralph Lauren $1 million, okay? Accounts payable are current liabilities involving money owed to others for merchandise or services purchased on credit, not paid for. So that's accounts payable, right? That's a liability, right? So owner's equity is the amount of business that belongs to the owners minus liabilities. So at the end of the year, sometimes referred to as retained earnings, the accumulated earnings from a firm's profitable operations that were reinvested in the business, okay? Not paid out to stockholders. So owner's equity is the amount of money I have at the end, something like that. A lot of times it's what I really am making on my business, right? So like that limousine service, going back to the example of Staten Island limousine, I have the 10 cars on the road. I have 25 drivers. They're out picking up people, dropping people off all year long. And at the end of the year, my business does $5 million in sales, but all my expenses for the cars, driver's salaries, for the rent, the thing, all my employees is $4.5 million. So the idea over here, I had $5 million in revenue, and I had $4.5 million in expense. You subtract that out, I have $500,000 for myself. So that's what it is. And retained earnings, the accumulated earnings. So I might take that $500,000 and I might buy 2 more cars. See, I'm going to take the $500,000. I'm going to take $200,000 out of it, and I'm going to go to Lincoln and get 2 more town cars, all right, or Continentals, okay? So what is the income statement? Is the net income or net loss, revenue left over after all costs and expenses are paid. So if my business, say like going back to the limousine example this year, because of the COVID-19, I had very few calls and I lost money. So my revenues were only 3 million, all right? But my expenses were 4 million. I had a net loss that year. I lost $1 million that year. So that's it. So and sometimes just about every company encounters at some time in its history a loss. Not every company every year sometimes you may make a very small profit. But this year, like Macy's is going to lose money. A lot of companies are going to lose money because they weren't open. They closed the stores down for months at a time. They had a lot of their expenses stayed the same, so they lost money, right? But hopefully they'll get back on track. So here's your formula, the formula for an income statement. It's a 5-step. You start out with revenue. See revenue, I made it in bold. I made it a little bit bigger. You subtract the cost of goods. So say like Macy's sold those those Ralph Lauren jeans for $2,500,000. Don't forget, they paid $1 million for them, but they sold them for $2,500,000. So you start out with $2,500,000. The cost of jeans was $1 million. So now they're down to $1.5 million, right? That's your gross profit. But I had expenses. Don't forget, when you're running a store, I have operating expenses. I have to pay salespeople salaries, commissions. I have rent. I have many other expenses. I think you subtract all that out. Then I have net income before taxes. You subtract out the taxes and your net income. So maybe after that, I might even only have a couple $100,000 to show for net income or net profit, right, on that particular item. So here's another term, revenue, the money, the monetary value the firm received for the goods sold. So the example I used earlier was $2.5 million on that particular department. And the cost of goods sold or manufactured is a measure of what did it cost me. So by the way, not only when I sell a pair of jeans, I have to pay for the jeans. I also have to pay, somebody wants a shopping bag. I put the jeans in a shopping bag. I give them a shopping bag. Sometimes I might have alterations. Sometimes in certain departments, men's suits, ladies' better dresses. I all have alteration. Maybe it's free alteration. I have to pay for that. So that gets subtracted out also, right? And then the gross profit or gross margin is how much a firm earned by buying or making goods and selling, right? Now here's operating expense. Don't forget, it costs me money to run my stores. It's costs involved in operating a business. I have to pay rent, all right? Even if I own the building, I still have to pay income taxes, a thing like that. Utilities, Con Edison, I have to pay my Con Edison bill. Salaries, all the people that work for me. Think of Macy's, you not only have selling salaries, you have the security, the people that are in the store, make sure that there's no theft. You have the people working human resources. You have janitorial people coming. At the end of the day, they mop up the floors, they clean everything up. You have lots of salaries in retailing. And depreciation, now this is a very interesting term. It's a systematic write-off of the cost of a tangible asset over its useful life. I'll go back to that example of the limousine, Staten Island limousine. Remember that one, right? Staten Island limousine. If I have 10 cars on the road and each car was originally valued at $100,000 and I have them on a 5-year depreciation cycle, I'm legally allowed to reduce the value of those cars by $200,000 each year. All right, so I report it, thing like that, and that's it. So these cars are not as valuable a year after I bought them. Why? Because they ride around in the city streets. They get a lot of the shock absorbers need changing. The tires are bald. Sometimes they get into fender benders. The seats get torn. These cars lose value very quickly. So I'm legally allowed to depreciate them. It's a legal write-off that you can do on your tax return, right? Now here's cash flow analysis, another important term. It's a difference between cash coming into a business and cash going out. Ideally, you want more coming in than going out. Sometimes you have more going out than coming in. So the thing I do over here, so it's a difference between money coming in and coming out of it. I'll give you an example. Here's a company that has tremendous cash flow, McDonald's. Every day, millions of people, I think they have about 40 million customers a day, each day, McDonald's, right? The people go in and they buy their Big Mac, they buy the soda, the coffee, the Egg McMuffin, and then they pay for it right on the spot. They usually use cash, they use a credit card, a thing like that. I'd say like your typical sale is $4. 40 million customers times 4 million, they have $160 million a day going into the coffers, all right? I'll give you another example. Here's a company, Boeing. You know what Boeing makes? Boeing makes airplanes. So this is one airplane. I'm holding it up. Obviously, it's a pen, but I'd say Boeing makes this airplane. So they sit down with American Airlines and they show them the new plane. and American Airlines says, I love this plane, give me 10 planes, all right? Now, Boeing gets a deposit on those planes, but then they got to go build the planes. It may take a year to build, 6 months to build the 10 planes. And then when they deliver the 10 planes to American Airlines, they get paid. So their cash flow is completely different than McDonald's, who get money coming in every day, right? So financial accounting is accounting information analysis prepared for people outside the organization. Who's interested in that? I'm just going to check my time over here. Oh, okay. Outside the organization. So these are people that is the organization profitable. I want to make sure I'm dealing. Don't forget, if I'm Apple, I'm not going to sell all that product to a company that's shaky, that's about to go out of that's about to go to Radio Shack or something like that. Toys R Us. If I'm Barbie, I don't want to sell a lot of Barbie dolls to Toys R Us when they were shaky, about to go out of business. Okay, is the organization profitable? Does it pay its bills? And how much debt does it have? A lot of times you can look at the company's financial statement, the balance sheet. How much debt does it owe? Some companies have. They look like very good companies, but they have a tremendous amount of billions of dollars in debt. All right. So the annual report is a yearly statement of the financial condition, progress, and expectation of the organization. And annual reports, just about every public company produces one. They used to be mailed to the customer. They come in like a little magazine. A lot of times they're online today. So you go onto the website of ExxonMobil. That's one of the biggest I ever saw. I owned Exxon stock a number of years ago, and I got the annual report mailed to me. It was maybe about 200 pages long. It's unbelievable, all the different financial data in there. But generally, you should look at the first couple pages, which is the statement by the CEO, the chairman of the board, or the president, and they tell you the condition of the company. It's usually a very declarative statement, right? So what is a private accountant? It's an accountant who works for a single firm, a government agency, or a nonprofit organization. So you're an employee of the company, right? Baruch has accountants, Citibank has accountants, JP Morgan Chase, and I think public accountant would be KPMG, Price Waterhouse, something like that. An accountant who provides accounting services to individuals on a fee basis, right? So if you're a company like Verizon, you have to be audited every year. So maybe your auditors are KPMG, a big accounting firm. They come into your company and they look over the records every year and they check things out, and then they make sure everything's up to par. And a certified public accountant is an accountant who has completed an accounting degree at a college like Baruch, and then they go and they have to take a series of tests. And as soon as they pass the test, they become a CPA. So any of you out there that are accounting majors right now, I urge you to get your CPA. All right. So I mean, even when you graduate Baruch, go out there. It may take you a couple of years later. Sit down and take the test, because as soon as you are a CPA and you're certified, that is a credential that you add to your name, Stephen Smith, CPA. That's a credential that's recognized around the world. So you can move out of New York. You can go to Anchorage, Alaska. There's CPAs. They're looking for CPA. You want to move to Honolulu, Hawaii. You can get a job there. San Diego and Chicago. Anyway, everywhere they're looking for CPA. So it's a very, very highly desirable credential. So I urge you, if you're an accounting major, get your CPA. What is managerial accounting? It's accounting used to provide information analysis to managers within the organization. So if I'm working for Macy's, I'm looking at what are my costs of running my store? What are my expenses for salaries? What are my lighting expenses? The thing like how much electricity we have. Thing like what is my maintenance expenses? So thing like what are my employee expenses? How can we maximize the use of employees? I mean, the managerial accounting, what is the cost of production, the cost of marketing, preparation of budgets, and also minimizing tax liability. Now, number 4 is interesting. I always tell students you should pay every single penny of money you owe the IRS. Don't ever cheat the IRS. However, don't pay more than you owe. If you owe the IRS $1 million, you don't pay $1,100,000, right? You pay them every penny you owe. Legally, you don't pay more than you owe. So auditing is the job of reviewing and evaluating information used to prepare companies' financial statements. An auditor is an actual position. You might run into a friend of yours after you graduate Baruch and you say, hi, Maria, what are you doing now? You know, you were in my class, Tommy's class, Business 1011. Oh, I'm an auditor. I'm working for Ernst & Young. I'm working for Price Waterhouse. I'm working for one of the accounting firms, thing like that. So it's an actual type. And these are people that visit companies and they look at the books and they make sure everything's up to par, right? That's what an audit. Tax accountants or accountants trained in law, tax law. They look to prepare tax returns, and they look for ways to minimize taxes legally. You have to do everything legally, but they look for ways to streamline taxes so you don't overpay. So that's it for chapter 17. Let's see, 17. And now we're going to go to chapter 18. Just give me a minute over here. All right, so here's 18, financial management. Can everybody see it?
Yes.
Anybody
Yeah, we
out
can see
there?
it.
You can see it?
Yes.
Yes?
Yeah.
Okay, great. So here's chapter 18. So here's financial management. This is another discipline, a very, very good discipline. By the way, Baruch is you should know this, you should write this down and remember it. Baruch College, the acceptance rate is about 28%. We're a very, very good school. You know, I don't say that just because I teach there, because I teach at other colleges as well. Baruch is a wonderful school. We have about a 28% acceptance rate. Do the math. That means 72% of the people don't get in. So the seat you're sitting in, 4 other people, here's you, 4 other people wanted to sit in that seat. We have a 28% acceptance rate. So out of 5, every 5 people, only 1 get in, okay? We're the largest, you should write this down and remember, we're the largest public, fully accredited business college in America. In America, you heard me, in America, we're the largest fully accredited public business college in America. And so the reason why people come here, we have a great business school, and these are disciplines that you can major in and then you get a good job. So finance is another one, accounting and marketing, information technology, whatever your choice. I'm not trying to talk you into a certain discipline, whatever you find you love doing, but there's a lot of jobs waiting. So here's another one that's good for jobs, financial management, right? So this is working in Wall Street, stocks, bonds, mutual fund, pension funds, insurance companies, all this money. When you pay your insurance, all the premiums you pay, that money gets put into, that money gets invested so that money can grow, okay? So here's your key terms. Finance, what is it? It's a function of a business that acquires funds for the firm and manages those funds. So they prepare budgets, they do cash flow analysis, what kind of money's coming in and what money's going out, and they plan for expenditures. How much do we have to spend, all right? So financial management is the job of managing a firm's resources to meet its goals. And managers are people that examine the financial data and they recommend strategies. We're spending too much money on electricity. We need, you know, maybe, McDonald's does in all their stores now that when they open up a new store, they have a skylight on the roof. And they have a lot of the sided walls are made of glass. You ever see this floor to ceiling glass, thing like that? When they're designing the store, guess why? Because natural light, the sunlight pours in, and you don't have to have you don't have to have a lot of overhead. Now they have overhead lights because the store operates when the sun goes down. But during most part of it, if you look out the window right now, I'm looking out the window, I'm in my kitchen, sun is pouring in through all things like that. I don't need any lights on. So how do we save expenses, all right? So here is who's who in finance, the CFO, Chief Financial Officer. He or she is the top person on the top rung on the ladder, the Certified Financial Planner, the CFA's Chartered Financial Analyst, and then you have to control. Each one of them is a title in the field of finance, okay? Now here's what they do. Let's start at 1 o'clock. They manage taxes. They advise top management on financial managers. They sit in on the board meetings. They collect funds from that's owed to the company. They control funds management. They obtain funds. A lot of times companies have to what they call get fund. What they do is they issue stock. They issue bonds or something like that, okay? The budgeting, they allocate the money to the different departments or thing like that. Planning, they look at planning. Let's see what happened over here. Let's see, I think I jumped ahead one. Let's see here. Okay, they do planning and they do auditing. So here's what 7 things worry financial managers, the consumer demand. I'm worried, are our products going to be desirable? Give an example. Elon Musk, everybody talks about, he's the king of electric cars. And he is. They make great cars, all right? But a lot of other car companies are coming out with their version of electric car, too. Audi has electric cars. Toyota has electric cars. You're going to have, let's see, Honda's going to come out with their version. BMW is going to come out with their version. Mercedes. You're going to have a lot of horses in the race. As a matter of fact, Volvo, I think the entire fleet is going electric now. So if I'm Elon Musk, I'm worried with all of this competition, people are going to buy my car, right? Credit markets, and what is the credit market's interest rate? Right now, the interest rates, because of this COVID-19, they went down close to zero, right? So if I'm a company and I want to issue bonds, I'm going to try to issue them now because I can pay very low rates, right? What are cyber threats? You'll talk about somebody hacking into my company, something like that. Identity theft, taking my trade secrets, something like that, okay? Financial regulation, what new regulations are the government coming out with? Volatility, the value of the dollar each day doesn't go up a lot, but here's the euro. There was a time the euro was $1.48 every dollar. Now it's about $1.06. Same thing with the peso. Each day they vary in value. What is competition from foreign competition, right? And also environmental regulation. What rules and laws are coming out that are going to affect my business, okay? So here is the value understanding of finance, most common reason. Why does a company fail financially? Undercapitalized, I mean they don't have enough money. I started a business, I'm running the business, a year or two into the business, I run out of money. I didn't realize it was going to cost. I thought I could start my business with $100,000. It turns out I had 100, I probably needed 400,000. I undercapitalized. So I burned through my money. I don't have any more money. And I just can't keep my business. So you're going to see a lot of businesses fail after COVID-19. A lot of companies just never going to come back, all right? Poor control over cash flow. Too much money went out. Remember I said money coming in versus money coming out. Here's the money coming in with too much money went out and too little money went in, all right? Inadequate expense control and spending too much, all right? So here's most businesses have predictable day-to-day needs, like they need to buy supplies, pay fuel and utility, thing like that, so they understand you have to have a certain amount of things. So here's financial planning. They have long-term financial forecasting, cash budget, how much cash we have on hand, how much do we need, the financial controls, the capital budget, and short-term financing. That's pretty much what they do. So what is a budget? Another important term. It sets forth management expectations and allocates the use of specific resources throughout the firm. The budget is the guide. So you have different departments. Maybe it's like I'm a company, I have 10 different departments, thing like that. And I decide I want to allocate $100,000 to each department, right? But my sales department, it turns out, are bringing in a lot of revenue. So I'm going to say, wait a minute, I'm going to allocate $200,000 to sales. And my security department, security isn't that important in our company. I'm only going to allocate $25,000 for that, something like that. So we're going to hire extra salespeople. And in security, I only have 2 employees. I'm going to make one of them full-time, one of them part-time, because I don't need, so things like that. That's how you budget. You divide the money out. Financial control is the process in which a firm periodically compares its revenues and expenses with its budget. So they actually compare one to the other, right? So here's the need for operational funds. Companies need money for day-to-day operating business, controlling credit, acquiring needed money. How much money am I going to need for the month of July? We're starting July now. How much am I going to need for the rest of the year till December? Acquire inventory. If I'm Macy's, I'm starting to bring in my merchandise, a thing like that for back to school. I'm planning on holiday. I'm planning Columbus Day events, Thanksgiving, all these different events. Managing capital expenditure. Capital expenditure would be, am I going to open up a new store? Going back to that limousine company, am I going to buy a new car? That would be a capital expenditure, right? So here's controlling credit operation. Collecting accounts receivable can be time-consuming and expensive. Accepting credit cards. So a lot of times companies say, I'm going to accept credit, even though there's a fee. By the way, as soon as you swipe a credit card, the retailer has to pay a fee. It's called a swiping fee. And then they also get the money. They don't get 100% of the money that they turn in at the end of the day. So these companies like Visa, MasterCard, American Express, and Discover, they get a lot of cash flow. These are companies that get tremendous amount of cash flow coming into their coffers each day, right? So here's alternative funds, a source of fund. Here's where I get money to run my debt finance. That means borrow. Whenever you see the word debt, it's fund raised through various forms of borrowing, and it must be repaid. When I borrow money, I must repay it, all right? Equity financing is money raised within the company by the sale of ownership, issuing stock. So a number of years ago, Facebook went public. Mark Zuckerberg sat down. He said, I'm going to need a lot of capital. I want to have great expansion plans for this company. I want to go international with it. I want to have these different platforms, things like that. I think when he first went public, they had about 1 billion users, and now they're approaching 3 billion, right? And the stock price, I think, went public at $27 a share, and now it's like $250 a share, I think. So they actually you're selling partial ownership of the company to outsiders. Short-term financing, how much money do I need for a year or less? And long-term will be more than a year. How much money do I need for 2021, 2022, 2023, right? So one is long-term. So trade credit, very interesting term, the practice of buying goods and services now and paying for them later. Most trade credit, and when I ran my business, my terms were net 30. What does that mean? If you ordered something from me, remember I used to sell wallets, I used to sell umbrellas, I used to sell jewelry, I sold some sportswear. And I would have a customer give me an order for maybe $2,000 worth of merchandise. I would ship the merchandise to them July 1st, so like today. And I would give them an invoice, and they were supposed to pay that invoice by August 1st. So that's 30 days trade credit. So when the merchandise arrived, they put it in their store and they start selling it, and then they would pay me. Unfortunately, they would never pay. Most of my clients never paid me on time. They used to pay me 60 days, 90 days. I had one company. It took a year before they paid me off. I had two people never paid me at all. They never paid me. One company, $4,000 worth of merchandise I shipped to them. They never paid. They went bankrupt. So I lost the money. What is a promissory note? It's an agreement with a promise to pay a supplier a specific sum of money at a definite time. So it's an actual legal contract. Pardon me, time value of cash. One thing you can never have too much of is cash. Financial management makes certain there's enough cash available to meet the financial needs of the company. So every company has what they call cash peaks and valleys. I'll give you an example. Say like you're a seasonal company where you have peaks and valleys in your business, something like that. You may have salary expenses where you have your regular salary expense, but you have very low cash. So what you do is you get lines of credit from banks. So you have arrangement with a bank that you're going to be able to tap in and add money to your coffers to pay your salaries. And when more money comes in later on, you're going to have that money and you repay the bank. So that's called a line of credit, right? So here's financing in retail stores, department stores, and other large retailers make extensive use of commercial banks and other lenders to borrow funds. So a lot of time, Macy's, Bloomingdale's, these companies, the inventory that they run their business on is what they call use with borrowed money. They borrow money at a rate, like whatever the prevailing prime rate is, and they hope that they can sell that money, the merchandise, at a higher profit, so it exceeds with the cost of borrowing the money. So if they're going to give you an example, say that they're going to pay 5% to borrow money, and they're going to have all their clothing in their stores, and they're going to sell that thing, and at the end of when they go through all the expense, they made 10% profit on that thing. So they're paying 5% to the bank, but they were able to use that financing to make 10%. So they double. So they got $2 back for every dollar. Every dollar that they borrowed with, they got two for one back, right? So what is a line of credit? This is what I was alluding to with the bank. It's a given amount of unsecured short-term funds a bank will lend to a client firm. I'll give you an example, another one. Verizon has tremendous payroll. They have hundreds of thousands of employees. So say like you have a month with 5 weeks in it. So say like some months, just because of the irregularities of the calendar, say like you had 5 Mondays in a given month, right? And say like everybody gets paid on a Monday. So Verizon has to issue 5 paychecks to hundreds of thousands of employees for those 5 weeks. But they can only bill, you pay your utility bill, certainly for your wireless thing, you pay it monthly. So they're only going to get, you can only send out one bill that month. So they have what they call a need for cash. So they have a line of credit with Citibank, with Bank of America, or Chase, for several $billion. So they just tap that line of credit, they pay the salaries of the people, and then when they bill, they send the bills out to money, all the money comes in, and that's how they recoup it, right? Same thing with Con Edison. Con Edison, same thing. So secured loans are loans that are backed by something called collateral. You see this house, a beautiful house, you see the car, each one of those things can actually be considered collateral. So say like I'm a business person and I want to start that limousine company, going back to limousine company. So I'm in business and I have my limousine company and I want to get 5 new cars, each car $100,000 each. All right. So I go to the bank and I say, you know, I want to expand my business. I have 5 cars. I want to get 5 more. So I have 10 cars. So the bank may say to me, well, Mr. Tormey, you look like you have a very good business. You've been a customer of ours for a number of years, but we're concerned about, you know, you want to borrow $500,000 from us. That's a lot of money. And although we trust you, we're concerned that we won't get that money back. So we'd like collateral. So we know you own your home. This is my home. Say like I live on Staten Island, and this is my home, and this is my car. They say, we're going to put a lien on your house, and we're going to use that as collateral. That house is worth $850,000, so we're going to have a lien on your house, thing like that. And so that's collateral. So I sign and I agree to that. That's what I call collateral, right? It could be. Remember I told you I had a big repair shop. I had a piece of land out in Staten Island. Maybe I have a building where I do all of the repair the cars, and it's like a garage. Maybe they want to put a lien on the garage, something like that as well, right? So what is equity financing? Is equity financed by selling shares of stock. So Mark Zuckerberg decided, I'm going to sell partial ownership of Facebook to the car. And there's a lot of companies that have gone public. Uber went public. Pinterest. You see a lot of these companies. So you see sometimes companies, you know, weekly, you can look on the financial charts and see what companies going. What they're doing is selling partial ownership. So equity financing is you're selling. So equity financing from user firms retain earnings. A lot of times you can actually use the earnings of the business to go ahead and reinvest into the business. And equity finance received from venture capital. That's like Shark Tank. And we talked about what venture capital was. It's money that's invested in a new or emerging business. So you watch Shark Tank, you watch some of these other shows. These venture capitalists are people that are constantly looking for opportunity. They have, you know, an amount of money, and they want to buy partial ownership of these businesses. And a lot of time, by doing so, they'll help you grow your business. All right. That doesn't always work. Sometimes venture capitalists lose money, right? So what is leverage? It's raising a needed fund through borrowing to increase the firm's rate of return, a thing like that. And cost of capital is another thing. That's what I was alluding to earlier. What rate of return am I going to get versus what it's costing me to borrow? I use the Macy's example. I'm going to borrow at 5%, and when I sell that merchandise, I'm going to get 10%. So my cost of capital is 5%. However, I'm making 10%. So I'm getting a 2-for-1 return. Some companies may say, we're not going to borrow unless we can get a 3-for-1 return, right? For every dollar we borrow, we want to get $3 back. Some companies may even have 4-for-1 return, whatever the internal thing in the company is. So that's pretty much it for today. We went over 3 chapters. I just want to go back to the main website. Hold on one second. I'm going to stop share. So here's our main website. Let's see here. So we were over here today. We're in chapters. Where are we over here? I'm in the wrong place over here. I got to go over here. One second. So if you want to recap, I'm going to post this video on, in case you missed it or you want to look at it again, I'm going to post it over here. And here was my video. So here's your 3 chapters, okay? And I'd like you to look at these videos on your own, all right? So I'm going to say goodbye to everybody now and wish you all a nice weekend. Hope you had a fruitful class today. We have about 61 people that are visiting with us. I appreciate that. Looks like about 60. That means 60 are not here, but that's all right. Maybe you're working or you have you know, other things. But I'm going to post this on the website. So have a great weekend, and I'll see you guys Monday. Don't forget, Monday's our last Zoom class, and a week from today, next Wednesday, you have your final exam, okay? Take it easy, everybody. We'll see you all.
Professor, I had a question.
Question, okay. What's the question?
Can you go over equity financing using retained earnings?
Yeah. Or I'll tell you what equity financing is. You have 2 types of financing. You have debt and equity, okay? Okay. Debt means I'm going to borrow money. So say like going back, I want to do that limousine company, and I have no money. But say like I was always a driver. I was a driver for many, many years, and I really know I really know the limousine business. I'm going to go to a bank and I'm going to say, you know, I'm Pat Tormey. I drove a limousine for 20 years for a company, and we don't have, and I live on Staten Island. Say like I'm just going to give you, say like there's no limousine company on Staten Island. Say I live there. I know the borough very, very well. I was a driver. I want to start a company. All right. So I go to the bank and I have a business plan. Remember that term from earlier on, business plan? So the bank sits down with me. Maybe I went to the SBA and they say, okay, Mr. Tormey, we feel you're a good risk. We'll loan you $200,000 so you can get started with 2 cars, all right? And as your business prospers, it doesn't like that, you can maybe add cars, all right? That's debt financing. I'm borrowing. I have to repay the bank that money, okay? Equity financing would be, if I have a company that's established, you pretty much have to be an established company in order to sell ownership to it. I'm going to give you stock. I'm going to say to you, I have 1 million shares of stock. I want to sell 1 million shares of stock at $25 a share, thing like that. And in order to do that, you have to go with an, we're going to talk about this next chapter, by the way. You go to an investment bank. Or an investment banker, by the way, you sat down with Zuckerberg way before he went public. By the way, the term is, by the way, it's called IPO, initial public offering. So you go ahead and you sell partial ownership. So now when somebody has the stock in Facebook or anything like that, they actually are part owners of that company. That's the way that works. So say like I bought the Facebook stock when it went public, the day it went public, $27 a share, and I invested, I bought 1,000 shares. I took $27,000. Now that today, that would be worth probably $250,000, all right? So, but it's not automatic because stocks go down, stocks go up, all right? So one is equity. I'm a part owner of the company. I don't have to repay. Zuckerberg does not have to repay me the money. He's selling me partial ownership of the company, equity. Debt is I have to repay the money. All right, you got that?
Yeah, but it said something like equity financing using retained earnings. What was that?
Say that again.
The slide said something like equity finance using retained earnings. I didn't get that.
Well, equity financing could be, yes. So you're taking the profit of the company and you're going to go ahead and reinvest that. So go back to the limousine company. Say like I'm in business a few years and I'm very profitable and I made $200,000 or $300,000 profitable. I'm going to take some of my retained earnings and I'm going to use that to buy another car. See what I'm trying to say?
Got it. Yep.
Okay.
Got it.
All right. So take it
Thank
easy,
you.
everybody. Have a great weekend.
Thank you,
Thank you.
Professor.
Take care. Have a nice day.
You too.
Thank you.